Happy Wednesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, August 14th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to stay on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, will the July CPI report support Fed rate cut expectations? Our answers are yes, unequivocally yes. We've argued for a month that the Fed and now the Fed should have cut rates in July. Investors should note that inflation, bottom-up macro regime inflation, according to our process, which is growth slowing and inflation accelerating, is now the modal outcome from a bottom-up macro regime perspective in the U.S. economy over the next 3 to 6 months. We are not concerned about the 3 to 6 month projection for reported inflation to meander higher, as we believe market participants are likely to downplay that dynamic as mere base effects, while anchoring on recent dovish trends. Currently, there is scant evidence of inflation misbehaving, and it likely won't until the first half in 2025. That is when our inflation forecasts start to diverge from consensus in a more material way that could represent downside risk to both stocks and bonds, especially if a potential Donald Trump 2.0 administration pursues mass deportation and tariff hikes as day one policies, the former being a negative supply shock to the labor market, and the latter being a positive shock to goods inflation. That is, the scenario we're talking about is, however, a scenario that investors will likely be forced to risk manage at a later date. For now, we believe our cautious optimism on risk is warranted. The accumulation of positive revisions to Dr. Mo's proper trade recommendations over the past week is supportive of that view. Transitioning to our 42 Macro community, as always, we'll wrap up with a question from our community here, 42 Macro client dashboard here. As always, we'll wrap up with a question from our community. This one's regarding research on inflation picking up the first half of 2025. It says, hello, 42 Macro community. I may have missed a few research releases over the past couple of months, hoping someone can point me to a specific outline of DD's thesis as why inflation will reaccelerate from here into the first half of 2025. Is there a particular research release I can read on this? The latest macro scouting report around the horn. So it's definitely in the left tail risk section of our latest monthly macro scouting report. Our sticky inflation theme, which we authored back in January of 2022, with the key takeaway that inflation was not transitory, and that we probably won't. It's very unlikely that we will return to the Fed's 2% inflation target on a durable basis with that in the absence of a recession. Thus far, both of those things have been true almost 3 years into that theme. That theme has been housed in our left tail risk section in our macro scouting reports. Obviously, we continue to see dovish pressures from a medium term perspective. We've received dovish pressures from a medium term perspective. We were out front and calling for inflation to slow, and inflation is surprised at the downside since we had that transitory backup in inflation in Q1. So we called that correctly. We think we're getting to the end of the good inflation news. Now, we're not at the beginning of bad inflation news. We just calling for inflation to meander higher as base effects start to ease over the kind of medium term. But by the time you get into the first half of next year, business cycle analysis, it's likely that inflation bottoms and starts to reaccelerate higher from there, because that's what inflation does in the absence of a recession. So again, I don't think we need to be concerned about that as investors until sometime in the first half of next year. For now, I think it's rainbows and puppy dogs, and our cautious optimism on stocks is warranted. So client, go check that out. Leftover section, our latest macro scouting report. And if you want to see that leftover section of our latest macro scouting report, or our macro scouting report broadly, which have not only have kept clients on the right side of market risk, have kept our clients peeking around the corner with much more accurate forecasts and much more explanatory information than the average investor is receiving out there, getting pulled in 1,000 different directions on finance Twitter and on finance podcasts. We're really proud of the deep dive research that we do on the business cycle. I haven't seen anybody do better research on the business cycle from the perspective of the seat that I sit in. I'm sure there's some folks on the buy side that have much better models than us, but we certainly don't see those, and those certainly aren't available to investors at these low price points. So we're really proud of what we're doing in terms of actually democratizing institutional finance. We're not just talking the talk, we're walking the walk on a daily basis, and thousands of our clients that really appreciate that. So hopefully you guys might appreciate it someday too. So until then, we'll catch you back here tomorrow. Cheers.